John, a tough time for the insurance market. I'm curious as to what your forecast breaks down to. So you're talking about $200 billion of losses for the industry, but that's underwriting as well as investment losses. Can you break it down for us?
Yeah, that's correct. I mean, tough time for our customers, and it's important that Lloyd stands up to be counted for the customers and pays its claims. So we've released our loss estimate today, but we've also estimated what we think the cost of COVID-19 is for the insurance industry globally, and that's just non-life insurers. So it breaks down really into about $100 billion that we think will be paid out over time in claims. So that's the immediate impact of the loss. It'll be the impact of the recession we're about to move into, and then the inflationary impact of recession on claims in the future. And then at the same time, as you know, insurers have their own investments, in effect their money to pay claims of the future, and the asset value of those investments has fallen by about $100 billion. So all up, this could be a $200 billion loss, which financially, as you said in your introduction, dwarfs 9/11 or even Katrina or even Harvey, Irma, Maria in 2017.
Will it be a big event for the industry, though? David Havens of Imperial Capital pointing out just in the last while that the industry is backed by something like $2 trillion of regulatory capital. So the industry should be able to withstand this pretty easily, no?
Without doubt. So I think the industry is solvent. The capital the industry holds is substantially above its minimum requirements. So at Lloyd's, if 100% is what you're required to hold, we're in excess of 200%. So there's no doubting the industry's ability to pay the claims, but it's a significant earnings event for everybody.
It's also broken up by you into the various different categories. So, for example, event cancellation is about a third of the losses, property losses about a third as well.
Yes, it is. So for us, about 70% of the loss, and we've said up to the 30th of June, the losses within Lloyd's we think will be around about $4.3 billion or up to $4.3 billion. 70% in three categories. One's event cancellation, from the high-profile events of the Olympics that everyone will know about to more local events. And there's also quite a lot of property coverage. So where businesses have bought a form of property cover that responds to the pandemic, then we're saying about 30% of our loss will come from those claims. And obviously credit, where we back banks and financial institutions, there'll be a credit crush as well, and some of the losses will come from there.
John, can you go into some more detail about regions? Because the vast majority of your losses are in the United States and worldwide, 58%. Yes. I mean, compared to something like 15% for the UK, for example. Where in the USA are you seeing the most losses? What type of insurance?
Very similar, very similar. So we're not really a classic domestic insurer, so we're not a big insurer of businesses in the US. So the same categories we've talked about are those that apply in the US. But 50% of the world's flow comes from the US, so we shouldn't be too surprised to see roughly that percentage come out in claims as well. It's our biggest and most important market, and it's our chance, once again, to stand up and serve the customers in the US to the best of our ability.
Well, you're also getting ready for the hurricane season, right? And the Atlantic hurricane season already almost beginning. What are you anticipating in terms of claims for the rest of the year and how that will impact the business, given you've already sustained such losses?
Well, there's something very important about Lloyd's, and that is we recapitalize in real time. So recognizing the impact of COVID-19, we've already spoken to the participating insurers in our marketplace to recapitalize, if you like, reload in advance of the North American hurricane season. So our allowances are set aside for what we anticipate will be the loss activity from hurricanes. You never quite know, but we feel okay. We're certainly solvent, and we're able, I think, not only to fulfill our obligations for COVID-19, but for all the other losses that will occur, and perhaps even US hurricanes through the balance of 2020.
John, what is being looked for from your company, from Lloyds of London, that you're not willing to do, if you like? So what kinds of claims are you fighting? What kinds of requests for coverage of this type of event are you fighting? We're seeing a huge argument here in the US between independent restaurants, for example, and insurers.
Yes. Yeah, it's very, very difficult. And I can understand the frustration from every quarter where, for many, and I think the majority, the business property cover does not cover interruption for this type of loss. It's a very specific extension that some have bought, but many haven't. So I can understand businesses' frustration. my recommendation would be that they speak to their broker to really understand the cover that they've got and begin there with a discussion as to what they might be able to do. It's for that reason, actually, today, we've also released a paper discussing a number of ideas that we might be able to do to help. If the pandemic comes back, then we should not find ourselves in this situation again. So we put some ideas down on paper for that, or
Yes.
even whatever the next event might be, if it's cyber or something even more sinister.
Yeah, I mean, these are interesting. I want you to go into some detail about this recovery idea in a
Yes.
moment. But is this, and I have to ask, is this an effort to be proactive so that you don't have to deal with any requests for back coverage this time, so that courts don't find that, maybe you do have a role to play in helping to restart the economy, even if it wasn't what was signed up for in the first place?
No, it's not. I mean, sadly, I remember the Ebola crisis and some of the fantastic products that were designed post that. There was a brilliant product called Pathogen X, which was a specific pandemic cover developed by Munich Re, the big reinsurer, in partnership with Marsh. Nobody bought the cover. So very, very sadly, when some of the covers have been designed, they just weren't bought last time round. So I think it's important that at a point where customers understand the value of insurance and maybe regret not buying cover they wish they had, that we ensure that problem doesn't occur again. So that's what we're trying to do. Sadly, where there isn't cover, there just isn't cover, and there's not much we can do about that. And that's really why governments are stepping in. But what we're trying to do is to say, can we stop this happening next time round to ensure that there are covers in place?
But isn't there, a role potentially for you guys in being the middleman? So with the understanding that the government might make you whole, you allow businesses to access liquidity and cash and so forth for now, so they can get up and running before they're no longer an entity, even before they no longer have any staff they can call on, or any expertise or any supply chains, before everything goes to the wall.
So I agree. And one of the ideas you just spoke about, we called Recovery, which is a sort of a prospective cover. There's a lot of talk of a second wave or possibly a third wave of the pandemic. So we're saying, how can you put cover in force for that now? And our idea is to look at a very long-term insurance cover, 10 years, 15 years, maybe 20 years, because clearly short-term, if the pandemic comes back, the losses will be very significant again. So an insurer would need to have a long-term cover to have confidence over time that there'd be some financial sense in providing the cover. So that's one of the ideas we put forward. We can't solve yesterday's problem, and that's why governments have stepped in. But let's try and solve the problem going forwards as we see it today.
John, how many quarters before your business gets back to something resembling some kind of normality? Prudential already saying that, forget about this quarter, and Asia is looking terrible. Nobody's buying any insurance products right now. So for the marketplace, what do you see? How many quarters?
So I think it's going to be difficult through 2020. I'd agree with that statement. And I think it'll be early 2021 by the time people have properly got their arms around the impact of the loss. But, I think the other thing, and it might sound a little incongruous to say this, but clearly if the industry will be suffering losses of $200 billion, then that unfortunately will have an impact on price. So prices in our industry will have to go up. So I think looking out and looking forwards, difficult though this is to say, often insurers do rebound quite quickly. And we talked about those big events in the past, and you then tend to see a year or two or possibly 3 years of some very good results. So difficult 2020, bit challenging into early 2021, but all things being equal, the outlook thereafter should be positive.
John, how are you preparing for people to go back to work? I mean, Lloyds of London is notoriously one of the places where people, still
Yes.
do want to go into headquarters, into the offices. It's not exactly the most conducive to work from home environments that there are out there. So how are you preparing?
It's a great question. We've been doing fine from home, but we do need to be physically present as well. So one of the opportunities we've been working on anyway is modernising and digitising the marketplace. So when we do return, we'll be doing a bit of what we're doing today, working virtually and really as well. But we'll be driven by government permissions. So our plans really show a phased return to work, but we certainly don't see the famous underwriting room at Lloyd's opening before August. And even then, that'll be conditional upon social distancing and what we're allowed to do. But it's potentially 3 months away still. But we're trading electronically and we're trading efficiently at the moment.